Hi, my name is Stuart Weems and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. Okay, let's get in today's Q&A session. The first question is from an anonymous listener that writes, "Thanks very much for your time and generosity in providing a wealth of knowledge information in your podcast. I listen to all your episodes on my commute to and from work every day and even play some episodes twice for extra reinforcement. Your book Investopoly has provided a sound foundation in which we have built wealth. Thank you very much for this." Oh, you're most welcome. And the reason I read that out is I wanted to mention, just because it's kind of exciting to share, is that with Wealth by Design, which is my new book, and I'm going to start talking about in the coming weeks some pre-orders. It's available for pre-order and it's published. It'll be in bookstores by the end of July, so not too far away now. But what I am working on is an AI tool that you can use to query the contents of the book and get it to write prompts that you can use in other AI tools. So that is, for instance, a prompt such as, here's my portfolio, my ETF portfolio, using all the information and methodologies explained in the book. Write me a prompt that I can then paste into Claude or ChatGPT or Gemini, whatever your preferred model is, that will then critique that model. And I built it and I've been testing it and the results are really incredible. Like, I think it would be really useful for people. One of the things that is great about books is that they, talk about really great concepts, but the reader is always left thinking, how do I apply that to my situation? And, I don't think AI is going to replace us overnight, but I think there's ways in which we can use AI to take these concepts and then help us better understand and query it so that we learn more and more and how does it apply to our situation. So anyway, this tool I'm really excited to share with the Investopoly audience and community. And I'm not only excited about the book, but this added tool I think will be really good. Anyway, so I just wanted to share that with you. And there's a pre-order bonus tool as well, which is another AI tool that's trained on all my blogs that I've been writing over, certainly over the last 10 years, which, most of which are now podcast episodes, of course. But, one of the challenges is, people have questions and quite often I've written about it or spoken about it previously. So that'll be a good tool as well. So I'll get there and I promise I won't always turn every question into a shameless plug of my own book, but I'm keen to continue to share a lot more sort of knowledge and insights and better tools, I think, with the community that we're building here. Okay, so to paraphrase this question from this anonymous listener, it's really around, they've got a target and they refer to, in Investopoly, I talk about make sure you've got a destination. It's a little bit like leaving home without a destination. You'll just drive around aimlessly. So a destination gives us context. So what do we want to achieve? In this listener's situation, it's $200,000 of income as soon as possible. And the listener also speaks about, reducing working hours. So it's good to aim for a goal or a destination, but there's a couple of ways to get there, right? You work full time up until a certain period of time when you reach that goal, or you have a sort of staged transition to retirement where you reduce working hours. And it just depends on type of assets you have and whether you need a greater contribution of capital, whether you just need time to do its thing. And quite often in many situations, it's about time. It's about kind of a race to a certain amount. If you have $700,000 in super, for instance, your contributions are probably not moving the dial too much. It's all about fees and returns. And so therefore, in that situation, it's more just about time rather than capital contribution. So it's a good way to kind of understand how a transition into retirement can occur and how important your capital contributions are to making that work. Of course, when we first start investing, our capital contributions is everything. It's 100% of how we're moving forward, because of course, if we have no investment in assets at all, then even a 50% return is still nothing, because 50% of nothing is nothing. So I guess if you chart it, you can see that there's heavy reliance at the beginning, and as your asset base grows, reliance on capital contribution reduces. So therefore, if you're able to work 3 days a week and that 3 days a week is enough to pay for your living expenses, that could be a transition to retirement. So that's kind of how it works. Okay, so this listener's asked for a bit of a critique or some advice in their situation about what they could do. So I'll just give a bit of a rundown. The listener and his wife, both 40 years old, working 5 to 6 days a week. Two kids, two boys, 8 and 10. Annual income 350 plus wife is 100 to 150. This excludes rental income or negative gearing. Home is worth 1.5 with 370 mortgage, 3 investment properties, 2 in Melbourne, 1 in Brisbane. Total value is 3.5 and total debt is about 2.1 million. Combined super is 680,000 and an ETF portfolio. They've only just started in a family trust, making $3,000 per month. The portfolio is actually worth $70,000 and they're maximizing superannuation contributions each year. Okay, so in this situation, and I'm glad I sort of gave you a bit of commentary before I answered because I'm going to circle back to that. So let's look at the investment properties. Let's assume they're good quality properties. They're going to generate reasonable capital growth over the next couple of decades. If we get 6% growth off that portfolio, the properties in 20 years' time will be worth $11 million. Let's say we still have the same debt, so 2.1, and let's allow roughly about 30% for capital gains tax. I'm recording this Q&A episode before the budget's released, so I don't know at this stage what the budget says, but let's be really sort of aggressive with respect to the amount of tax we might end up paying. That leaves us, if we go and sell all 3 properties at age 60, leaves us with about $6.6 million in 20 years' time, which is about $3.6 million today. I know $3.6 million today after tax should be more than enough money to pay for $200,000 a year. So really the property assets for these people, these listeners, are probably going to be enough by themselves to fund retirement. But of course, we wouldn't want a strategy that would be so single point sensitive. We've got superannuation, which totals about 600,000. Let's say they're going to have about $2 million, probably in excess of $2 million, probably substantially in excess of $2 million. But let's say then by age 60, they're going to have 2 mil of super and 3.6 of net equity in property on an after-tax basis. It shows us that a capital contribution to their strategy at this point is not really necessary, like it's not that big a deal. So what do these people have to do to bring forward their plans so that they're 40 today? What about if they're looking at sort of partial retirement in their 50s, let's say 50, 55? What would I do in their situation? Well, I mean, you're going to have to repay the home loan, which is $370,000. So you certainly want to do that, but it's not high on the list in terms of priorities. You need to get there, but it's not high on the list. Repaying any debt against the investment properties is completely unnecessary, notwithstanding your loan to value ratio now is pretty conservative. So if you have those loans, make sure they're interest only and keep them on interest only. That's not a key success factor. It's really about capital growth and making sure those assets work really well behind the scenes. You're maximizing super contributions. There's nothing additional you need to do there. Keep doing that. That's important because it'll buy you some time. In 20 years' time, you might not want to go and sell all 3 investment properties. And I'm not suggesting that would be a good idea, by the way. You probably stage out of those investments over a long period of time, but making sure you've got superannuation that is liquid, that can really pay for all your living expenses, at least in the first part of retirement, gives you flexibility around potentially divesting of those property assets. So then really it's about having a pool of liquid assets that allows you to retire sooner, so that if you decide to work 3 days a week, and let's say that was enough income to pay for 80% of your living expenses, that you want a pool of liquid assets that you can draw upon to top up that 20%. And that's an ETF portfolio, to my mind. You've got it in the family trust, which is ideal because, in 20 years' time, you've got some tax flexibility. You might be able to distribute to adult children, for instance, that might be on maternity leave, not working at that particular time, and you can utilize their tax-free threshold, for instance. But who knows what happens in 20 years, right? So you want to have that flexibility. So I like the idea of the $3,000 a month. You might add a little bit of gearing into that strategy, noting that, you do have a relatively low loan to value ratio against your investment properties, and also just to get that portfolio started as well from a capital growth perspective. And you might be strategic around that gearing. So, you might just be putting your $3,000 a month. And when the market does hit some volatility, maybe you take out 100,000 out of a separate investment loan and then invest that in the family trust. Just be careful. You'll have to borrow the money probably in personal names. You've got to speak to a good mortgage broker. Borrow the money probably in personal names. Have a loan agreement on lending into the trust, so that essentially you're charging the trust the same interest that you're paying the bank. So your tax position is neutral and essentially moves the interest deduction into the trust. Just be careful if you're doing this in a trust to not crystallize a taxable loss. So you want the level of gearing to be conservative enough so that it's still recording a profit. If you register a loss and you have any imputation credits or tax credits that come off the portfolio, you will lose them in that particular year. Now, if the balance is $70,000, that's not that big a deal, and probably not forgoing a lot of money, but it's just something to think about in a gearing strategy. In a family trust, you want to keep that gearing at a neutral level. I think over the next 20 years, your properties are going to become positive cash flow just because of rental increases. Debt stays the same. Inflation will increase the rental income, of course, but in real terms, decrease the interest cost. So I think the fullness of time will be enough for your property assets to become positive cash flow. So I don't think you need to do anything in the debt reduction side. I said you need to repay your home loan. You're maximising super contributions. Just make sure you're in the right fund there. And as I said, the only other thing I would do in your situation is over the next 10 years, really focus on that ETF portfolio. I would imagine in 10 years' time, you're going to be in a really great position where then it's about contemplating at what stage do you enter into retirement. And I should highlight in that situation, working 2 or 3 days a week, and therefore you don't need to draw the full 200,000 off your investment assets, has a substantial compounding impact. So that will be really doable in terms of early retirement. Off the top of my head, this is not advice, of course. Early retirement in your early 50s. But if you're looking for full retirement, you're probably closer to mid 50s at a guess from the numbers that you've told me. But you've done really well, and I wouldn't really change much. I think you've really kind of followed the process, which is get those property assets in there, then start maximizing super contributions, then building out a more liquid asset base, and something that I talk, probably more definitively or clearly about in the new book, Wealth by Design. But well done to this listener. Hopefully that answer is useful to you and people in similar situations, and all the best. Okay, next question is from Julia. I'm an avid listener of your podcast. I want to congratulate you on continuing excellent financial content. Eagerly looking forward to the release of your new book. Oh, that's good. I'm someone who's likely to exceed the $3 million super threshold well before I'm able to meet the concession of release. Are you able to clarify whether franking credits are going to be taxed twice under Div 296 super tax? So I guess we'll be hearing more about Div 296 super tax. I should do an episode on it so that people understand it better, but it's really probably better described as a surcharge rather than a tax. And the reason I say that is, surcharges are sort of different to, it's almost like a fine, if you like, different to a tax. A tax, by definition, by my definition at least, is, I'm taxing you on your gains, whether you've made, income or capital gains or whatever. And it's really about working out what that gain is properly and then applying a tax rate. Where a surcharge tends to be just a flat, percentage based. I'm going to tax this element, whether it's the value of an asset or, whatever it is, a more fixed entitlement. I don't know if that sounds like a bit prattly-on-y, but essentially you've got your core taxation, which is unchanged within super, which means that if you've got a mountain pension phase up to the transfer balance cap, there's no tax. Over and above the transfer balance cap or in accumulation, you're paying 10% on capital gains and 15% on income. And on that income, if you get imputation credits, dividend credits, so forth, you can offset and reduce that tax and potentially get a refund. So that works. That doesn't change. And then Div 296 comes over the top. It has its own definition of earnings in that particular period, which includes dividends, which also includes imputation credits. And you've got to pay that tax. You're not going to get a refund. So you might get a refund on your standard tax, but on the Div 296, 6, there's not going to be a refund to offset imputation credits. There's been some criticisms that the whole imputation system was supposed to give you a credit for the tax that the corporate has already paid, and that, by including imputation credits in the Div 293 taxable income, you're essentially applying a tax rate on a tax. I think both those arguments kind of have merit, but I think the answer around Div 296 is to dissuade people from having too much money in super. That superannuation was designed and it gets to fund retirement, and it gets tax benefits for you to be able to achieve that. Arguably, if an individual has more than $3 million in super, they've achieved that aim. And so now it starts to become, or it's being used as a tax haven for wealthy individuals. So we can have an argument around whether it's conceptually correct in terms of how they're administering Div 296, but if you come back to, the sole purpose test for superannuation, which is a retirement savings vehicle, I don't think we're going to get much sympathy. It is a fine almost for having too much money inside super. So the answer is, when you get to condition of release, have a think about taking some of that money out of super, and be careful because they've got some tricky rules around opening, closing, and average balances as well for people to try and avoid it by taking a little bit of money out or in June before the end of the year. So I said I probably need to do an episode on it to educate everyone around it, but I think it's more of a planning exercise. I guess for those people that have more than $3 million before they're age 60, so more before they can actually take it out, I guess my answer there would be, well, if you're only marginally over the balance, we're not talking about cheap stations. Like, the amount of tax is proportional. So, if you only have 3.3 million, you're sort of 10% over that amount, or you're going to attract sort of 10% of tax. It's not going to move the dial very much. So probably nothing to get too excited about. If you're lucky enough to have a lot more than $3 million and you're, say 50 years old, so you're 10 years away from being able to actually draw it out, it could become a bigger planning issue there. But I don't think that's going to be that many people, right? I think most people, if they're going to get close to the 3 million, they're probably in their 50s and not too far away from retirement, and they're only breaching that cap by proportionately a smaller amount. So it's not going to move the dial too much. But it's an interesting tax, and something we need to really start thinking about in our advice. Although what we find typically in our strategies is in the late 50s or early 60s, we're actually moving money inside super rather than anything else. So what we actually find in our strategies is that typically we're below the transfer balance cap, and it's really about whatever assets we have outside, we're going to start moving into super. So I think from what I've seen in terms of our experience, I don't think it's really going to cause too many problems. So then it's really just a post-retirement planning phase in terms of if assets have performed really well, maybe we've got to pull them out of super and put them into a family trust, for instance, if that's going to give us better tax outcomes. Anyway, Julia, thanks for your question. I don't know if I've answered it. I've answered it as best I can, given I don't know your individual circumstances, so I can't give you an example of how it might apply in your situation. But yeah, there's some criticisms there. I think it's just about, if you're only a little bit over the 3 mil, it's probably not going to cause you too many sleepless nights. And as soon as you get to that condition of release, that's something that you might want to start thinking about correcting. Okay, next question is from Ruth. Ruth is 50 years old, earning somewhere between 175 and 210,000, with about $380,000 in super. Doesn't salary sacrifice anymore inside super. Still has 3 children, but one is still a dependent. Recently repartnered. He's 51, earning $120,000 a year with $250,000 of super. Just bought a house together, which they owe $800,000, and the mortgage is costing about $4,500 per month. But the crux of the question is that Ruth has a investment property in St Kilda East. It's an apartment. The mortgage is about $350,000, and the investment hasn't done well. There's been no capital growth. It's negatively geared, so it's losing money, and which is great from a taxation perspective, she says, but not so great from a wealth perspective. And the question is, should she consider selling that investment and putting some of that money into an ETF portfolio? So it's a pretty common common question, Ruth. Anyone that's bought a investment grade or older style apartment in the last 13 to 14 to 15 years in Melbourne would not be very happy as a general rule with the capital growth. In fact, most would be incredibly disappointed, very frustrated because, the cost to hold those assets has risen considerably over the last 15 years at a much greater rate, I would argue, than inflation. And tenancy laws have tightened up, as I covered in an episode more recently, but we haven't been rewarded with capital growth. The reality is, in today's market, you will have to sell that property for less than it's intrinsically worth. In fact, in many situations, you could be selling for close to land value or maybe less than attributable land value. So, if you want to move that property on, the cost to do so is that you're going to have to sell it for a bargain for the purchaser, not for you, which is not ideal, right? It just compounds the loss. Not only do you have had no capital growth, but now you've got to sell it for less than intrinsic value. It doesn't make a lot of sense. In those sorts of situations, if you don't have to sell, I would say keep it. And typically what I'm telling people at the moment, at least keep it until November, right? Let's see what happens with the election in Victoria in November, because if there is a change in government, and I really hope there is, if there is a change in government, that could give rise to a change in sentiment. And all you need to do is start seeing the value of that property rise, and that'll give you some confidence to hang in there a little bit longer. The challenge is, as investors, is to hang on to a property when it's doing nothing, or worse still, going backwards in value. I mean, it's guaranteed every month we're going to have to pay interest to the bank. Every month we're going to have to pay our property managers to look after those properties. So they're guaranteed. What is uncertain is capital growth. If we're getting $10 of capital growth and paying $1 out, we're pretty happy. But if we're getting no capital growth and we're paying $10 out, that obviously as investors makes us feel unhappy. So I know that all markets move in cycles. We know that, if the asset is fundamentally sound, even if it's not fundamentally sound, it's still underperforming at the moment. It'd be a shame to get rid of it. And if you've held it for the last 5 years, you've done some of that hard work already in terms of having the patience of an investor to hang on to an asset, even though the returns aren't attractive. So it would just be a shame to divest of it today, put that money in another asset class, and then read in the paper in 3 or 4 years' time that property is resold again for substantially more than what you sold it for. With investors, sometimes you just need patience with investments, I should say. So look, I'd hang on to it. And even if you can't at this stage, commit to hanging on to it for the next 5 years, then at least commit to hanging on to it for the rest of this year. Save for a change in government. Let's see what happens with interest rates as well. And then maybe middle or end of next year, if we're then in a cutting cycle potentially, and we've had a change in government in Victoria, let's see what happens then. If it's still not performing, well, let's keep listening to this podcast, but at some point we're to draw a line, but I don't think we're at that point at this stage. So Ruth, I hope that you can hang on to it, and good luck with everything. Okay, next question is from Ray, long-time listener of the podcast, learn a great deal from it. Thanks for your insights. You're most welcome, Ray. My wife is 53, I'm 55, both working full-time. Combined income is approximately $600,000 per year, so very high income. Combined super balance is around $800,000. We own our principal place of residence, which is worth 1.8, which is fully offset. The loan's fully offset. And then Ray's listed 4 investment properties worth $5.8 million with about $2.5 million of debt against them. My key question is whether it would be sensible to sell North Melbourne now. So she'll actually go through them. One's in a Bayside suburb in Melbourne, a newly built townhouse. And another one is a house in an eastern suburb of Adelaide. Another one in a northern suburb of Brisbane. And then a house in a northern suburb of Melbourne. So it's really, should I sell the house in northern suburb of Melbourne? It was purchased in 2020, by the way, to reduce overall debt with the aim that rental income will then cover all outgoings. So the property will be washing its own face. And more broadly, we're wondering whether the current position allows us to reduce working hours over the next few years. Well, firstly, when looking at a property portfolio, we've got to form a view on time horizon and future returns over that time horizon as well. So what I would be looking at is to say, of these 4 investment properties, what are the likely returns over 10, 20, and 30 years? And if you look at Brisbane and Adelaide, for instance, given that they're both probably more than 50% of the way through a growth cycle, and the fact that Melbourne hasn't entered into a growth cycle yet and hasn't had one for a protracted period of time, you would have to say, based on the data, based on the overwhelming evidence, that the returns over the next 10 years from the Melbourne properties is likely to exceed the Adelaide and Brisbane properties. And now I know that sort of bucks kind of conventional wisdom, or logically you would think, I don't want to get rid of those properties. They're the actual best performing properties in my portfolio. I get that, but it's really about opportunity cost. And the opportunity cost is, if I sell this asset today, I get to reduce debt and potentially retire soon. Okay, that's the positive. The downside is, what future returns will I forego by selling it? If I sell in Adelaide, for instance, and let's just pretend, I'm not saying this is my view, let's pretend Adelaide is at close to the peak of the market. Well, it's entirely possible, and we know that maybe the next 7 to 8 years will be pretty flat in terms of returns, right? So what I'm foregoing by selling Adelaide in that scenario isn't that much. What I'm gaining is substantial because potential early retirement. So when you're contemplating selling an asset, it's really about forming a view around future returns and probably forming a view around shorter term future returns. So I said 10, 20, 30 years. Yes, you've got to consider what are those longer term outcomes, but it's really the shorter term returns that you're really trying to contemplate, probably 5 to 10 years, because you might form the view, well, I'm going to sell one over the next 5 to 10 years. That's almost certain. It's really just about a question which one. So that's the first thing that I would really contemplate. And so the answer then would be probably no. I wouldn't sell any of them, I don't think. I'm not going to sell the Melbourne ones because I think if I'm selling a property in Melbourne at the moment, I'm selling for less than intrinsic value. That's not true in every situation, but I think to get a sale away in this market, you're going to have to be prepared to sell for less than what you think it's intrinsically worth. And, if we're not in a position where we have to sell, I just don't think I would do that. That's not in your best interest, of course. And, I'd still hang on to, I've spoken about Brisbane 2032 Olympics. I think positive sentiment will remain strong until then. Adelaide, who knows? I mean, markets can run a lot longer and harder than anyone can expect. So it's entirely possible that Adelaide still has another 4 or 5 years of growth, after which time in 4 or 5 years, it'll be overvalued. There's probably, I don't think I'm sticking my neck out by saying that, but that's possible. That could be a possible outcome. So I don't think I would sell any. In terms of early retirement, you've told me about sort of property assets and super. So the only way you're going to be able to enter early retirement is if you sell a property asset. I think notionally, you've got enough net worth. It's just, do you really want to go and make those changes now? Given Adelaide and Brisbane are still moving on, I don't really want to sell any of the Melbourne property assets. And it sort of goes to, some of the observations that I've made through the podcast episodes on a normal Wednesday and through the Q&A, that we don't want to be single point sensitive. I want to have some super, I want to have some property assets, and I want to have a share portfolio. It's exactly what I have personally, and it's exactly the same advice I give clients. And the thing we need to remind ourselves too, and I think that this is a useful reminder, because the last 10 to 15 years in the share market have been stellar. Like really, it's been a good period of time. I mean, the last 10 years in the S&P 500 is like 15%. We've got to remind ourselves that that's unusual. And, for a lot of people, it's been, property and ETFs and everything's been working really well. And if you've had a property in Adelaide and Brisbane and to a lesser extent Perth over the last 5 to 7 years, and you've been investing in ETFs for the last 5 to 7 years, you feel like you're shooting fish in a barrel. Like, how easy has it been to make good returns? But the reality is that markets don't always behave like that. I remember a period of time, especially after the GFC and even before it, where the US market wasn't doing so well and Australian property was shooting the lights out. So diversification is key. I think diversification in ownership structures, so super and assets in individual names, and diversification asset classes is critical. And so for Ray's situation, he would have been better served perhaps not buying 4 investment properties, but buying 3 and then building an ETF portfolio that then helped him transition into earlier retirement. So I think if he wanted to retire early, I think he's got enough wealth in order to do that. It's just, it'd be a shame to execute on that because you've got to sell an asset at this stage. And it'd be a shame to do that given where they are in the cycle. So, Ray, in your situation, yes, you probably are pretty close to being able to retire early, certainly in the next 2 or 3 years, maybe sooner if you really pushed it. But it really just depends on how these property markets behave. I would say that if I was in your shoes, I would hang on until I felt like Adelaide is close to the peak. And that's incredibly difficult to tell. So, you've got to make friends with the fact that you might end up selling 2 or 3 years before it really does peak out. But maybe hang on to Adelaide for another few years. And when you get to the point where you think, oh, look, I'm ready to hit the button on this, then maybe the answer is sell Adelaide, put the money in the offset accounts of the other properties and use those monies. So dip into those offset accounts to pay for your living expenses and even consider maybe a transition to retirement as well. So working a few days a week or doing something that limits the amount or reduces the amount that you have to dip into those savings. I think it's there. It's really just around now market timing and, what might happen over the next few years with those different property segments. But I'd be loath to sell the Melbourne properties at this stage. Like I said to the previous listener question, at least don't make that decision before November or maybe the first half of next year, because depending on what happens in Victoria, sentiment could change. I'm not saying it will, but it certainly could. Okay, final question I'm going to tackle today is from Keith. It's probably one of the longest emails I've received, a question. I mean, I appreciate that sounds like I'm complaining. I'm not. I'm happy to read through the emails, of course, but I guess sometimes there's more information that's necessary. As I understand it, just a really brief rundown, Keith has a self-managed super fund with about $4 million and about some shares worth another $4 million outside of super. So $8 million net worth. He's 60 and he's been retired for a bit, just trading shares and so forth. And now he has to navigate Div 296 tax. And he's asking, as I understand it, what about just taking some of that excess money out of super and going buy a family home, a principal place of residence, I should say, lives in Melbourne but has never bought a home before? Without going through all the information in the question, the answer is we're never going to be aligned in methodology. Keith shares some observations. His parents have been landlords and the challenges associated with that in terms of dealing with repairs and costs and these sorts of things. That I will not argue with. I think it's becoming more challenging than it's ever been to be a landlord. Hopefully that changes in the future. I'm not optimistic, but it's certainly very challenging. But the way that Keith's built wealth is through direct share investing. And, he said his returns have been great because he's been in technology and healthcare, but hasn't really served him very well over the last period of time. He's actually lost a couple of $1 million of wealth as a result of that. And, that's just kind of against my methodology. I've seen lots of investment portfolios. The reality is that I just don't know how you think you're going to outperform the market by direct share investing over long periods of time. Entirely possible to be right and correct and outperform over certain periods of time. And there's been plenty of investors that do that. But the consistency to beat those returns, because you've always got to be thinking relatively short term rather than long term, it's never really going to work. And the question that you're asking, Keith, isn't really an investment question. I'm really not sure how to frame the question. It's a tax avoidance question, perhaps. Okay, yes, we've got Div 296 tax coming in, which applies to balances greater than 3 million. Keith's got 4 million inside super, so it's going to have to pay a little bit more tax. And what Keith's asking is, should I take some of that money out of super, put it in a primary place of residence and avoid tax there? You can avoid tax, but what about the returns? And, I think someone that has $8 million of net worth probably can afford to pay a little bit of tax as well. I'm not advocating for paying for more tax, but what I think is the question you've asked me isn't really an investment question. So I don't know if you should take money out of super. If tax is your primary objective, then yes, taking money out of super is going to achieve that. But if you're, concerned about being a property owner and the expenses associated with that. And I guess it depends on what your earnings will be inside super. That I can't comment on because, you're not employing the same approach that I'd employ. And so I don't know what assumptions to make there because it's entirely possible there won't be any returns, possibly depending if you've got a very concentrated portfolio or what technology and healthcare sectors do in the shorter term. What we want to do is invest in a way where one sector and one particular stock in the medium term don't have any impact, or at least not a substantial impact on our portfolio's behavior. To me, that's the best way to invest. So sorry, I can't help Keith. In fact, Keith Cozy says, I just reread this, it doesn't like ETFs. So, it's kind of the antithesis of sort of everything I talk about. Anyway, that seems like a good place to leave it today. A little bit longer episode, so apologies for that. Tomorrow, I'm going to talk about superannuation strategies as we lead into the end of the financial year. It seems like now is a pretty good time to talk about all or at least most of the super strategies that I guess investors should be considering leading into the end of the financial year. So until then, bye for now. And before you go, if you enjoyed this episode, please share it with someone that you think will get value from it. And if you have a moment, leave a rating or review on Apple Podcasts or Spotify, as it really helps more people find the show. If you have a question you'd like me to answer in the next Q&A episode, email it to questions@investopoly.com.au. And if you'd like to learn about my new book, Wealth by Design, which is out in a few months' time, head over to investopoly.com.au/book. The link is also in the show notes. And you can also register for the pre-order offer, which is an AI tool that you can use to get more personalized value out of this podcast. Thanks for listening.